Thank you for joining me. I'm Alex, and I would like to talk about safety of principle today. And I would like to talk about it because it's Warren Buffett's number one metric when deciding to evaluate a stock. Pretty much the first question he asks himself whenever evaluating pretty much any company is there a safety of principle? And I'm wondering, should it be the number one metric? And why? So, what is safe? The whole thing revolves around comparing stocks to US government bonds. US government bonds obviously have never defaulted, and you can rely on getting your money back at the end of whatever term you're buying government bonds for. So let's say you buy a 10-year government bond right now, you can pretty much rely on getting your money back and some interest in 10 years. But when you're dealing with stocks, you kind of don't know that. So obviously, some companies are safer than others, and some companies you can rely on them not going broke in the next 10 years. But for most of them, you can't. And that is my last point. Is it important? And did things change in the past, let's say, 60 years? So Benjamin Graham wrote the book on it in 1949. And safety of principle was discussed back then. And I think that for most of the stock market issues, a lot of things have changed. Now, to get back to the first point, US government bonds are safe. But are they as safe as they were in 1949? And I would say that they're not. So we're dealing with trillions of dollars in deficit and debt right now. 8 trillion in deficit, trillions in debt. So at some point you have to wonder if there's going to be a point where the US will not be able to pay back the government bonds. And I would think that if we continue on the dangerous path that we're on now, that point might come. But I don't really think that we're definitely going towards a path of no return here. So, is, let's say, a Walmart stock as safe as a US government bond? And I would say no, but it's got to be close. But for a lot of things, what used to be the safe option is no longer the safe option, and consumer spending has so drastically changed that there basically are no safe companies anymore. I could not name a single company right now that I would know would be around in 50 years. I assume that there are many companies that will be around in 10 years, but even that is not a given. And with the pace of innovation being so high right now, I really don't think that anyone can make a definitive statement about what company is safe in 10 years. 10 years is a very short investment horizon. So I think that a lot of things have changed, and I think that safety of principle is probably not the number one metric anymore. Now, I come from a perspective of having been a professional poker player where safety of principle is literally never given, and there are other things that are more important and that you need to weigh against that. And what I mean by that is, if I were faced with a stock that literally had a 90% chance of going broke, but it had a 10% chance of having 100 times the return, I would definitely invest in that. Now, obviously, I wouldn't invest all my money in that, but I would invest in it. And that tells me that safety of principle is definitely not my number one concern. It's just one of the factors that I need to account for when valuating a stock. So is the safety of principle enough to justify the gains that I'm expecting? And let's assume for a minute we're talking about, let's say, a physical retailer. And I have a specific one in mind. So if I were looking at, let's say, JCPenney right now, and I would have to evaluate safety of principle versus the expected stock market gains. And I would assume that there's basically a 50-50 chance of whether or not they'll be around in 5 years, let alone 10. So with that said, do I need to evaluate the stock at all? Or is there a threshold to where I think it still makes sense to invest in that? And the answer is, I think you should still investigate that stock. So if you have a very safe stock, let's say a Walmart. Let's say Walmart is at $100 right now. It's currently at $117. So let's say Walmart is at $100 right now. They pay 2% dividend, and they're probably gaining about another 3% per year. So let's say that you factor in a growth of 5% per year. So in 5 years, you have slightly more than 25% growth. Since it compounds, you're looking at probably around 30% growth, maybe a little less than that. But for every share you buy right now for $100, in 5 years you will have about $130. So if you invest in JCPenney, what are the chances and how much money are you going to have in 5 years? So let's say there's a 50% chance they're going broke, so you're left with zero money. The practice is not quite that simple, but let's just assume that. So then you would have to have $260 the 50% of the time that they don't go broke. Now, I obviously in this very case would not expect that to happen. I would not expect the JCPenney stock to go up 260% or 160%. Yeah, 160%. So a growth of 40-ish% per year. So I still think that you should evaluate whether or not the stock makes sense. And obviously in practice, we're looking at stocks that maybe have a 2% chance of going broke, maybe have a 5% chance of going broke. You will very rarely have a stock that has a significant chance of going broke. And in all the other cases, you also need to worry about what are the chances they're going broke. So in the case of Walmart, obviously there is a chance, but the chance is not very high. So is it a 1 in 1,000 chance that they're going broke? Is it a 1 in 10,000 chance? And the same goes for government bonds, by the way. What are the chances that in 10 years the government is going to be able to pay you back? Is it a 1 in 1,000 chance they're not? Is it a 1 in 10,000 chance they're not? The chance is definitely there, so you definitely need to factor that in. But in the case of government bonds, it's fairly easy, because if the government is not able to pay you back, your dollars have no value anyway. So that makes it simple. You can just disregard that whole line of questioning. If you invest in literally anything and the government is not able to pay you back, you don't have any money anyway, unless you invest in like Chinese companies, and somehow that makes sense, because currently you cannot directly invest in Chinese companies, and that's a whole different thing that's very difficult to explain. But let's say you invest in German stocks and the US government is not able to pay you back. Even the German stocks are going to take a nosedive. They're going to take a significant nosedive. because the US government is the biggest government in the world, and if they're going broke, it will definitely take the whole world economy with them. So, again, with government bonds, you can completely disregard that, but with any company, I think it's something to take into consideration, but I don't think that you should give it as much significance as it currently gets. Like Tesla, for example. There's definitely a non-zero chance that they're going broke. But is it 1%? Is it 10%? Is it 0.1%? So 1 in 1,000? I would think that the chance of Tesla going broke is less than 1%. So do you take that into consideration? Do you completely disregard Tesla as a company to invest in because of the non-zero chance that they're going broke? I think that's a mistake, because the upside with Tesla in particular is huge. And I don't think there's currently any other stock that has the same upside. Maybe Facebook, but I think that Facebook is kind of the only thing, and things would have to align just right for Facebook to actually become a significant player in the global market. But regardless, beyond Facebook and Tesla, I don't think there's anything out there that is going to have such a huge upside and a non-zero chance of going broke. So that's kind of my point of view. Don't disregard companies because they might be going broke. Do disregard companies because the upside is not as big as it needs to be to justify the non-zero chance of going broke, basically. Anyway, that's it for me for today. I'm sorry for rambling. It's a very difficult thing to explain. If you'd like videos like that, make sure to subscribe if you haven't already. I'm coming out with more videos every day before market open. I hope you have a successful day.